tokens are rather combined with real-world assets, things like racehorses or oil or real estate or even Claude Monet Masterworks. This next panel will discuss that with David Smooke, who likely needs no introduction in this audience. He is the CEO and founder of Hacker Noon, a tremendous tech publication that has, and here he comes. There we go. All right, David.
Hey, thanks.
Welcome.
Hi, everybody. Thanks for having us here today. We're going to talk about tokenizing alternative assets. I'm David, founder of Hacker Noon, the tech blog. And today we have a lot of people that are taking assets that are very old, tried and true, and moving them onto the token economy, real estate, art, and oil. So I'm going to get right into it and let each panelist talk a little bit about their work and their basic approach to tokenization.
Cool. My name is Ari. I'm with a company called Slice. We help non-US investors to get access to US commercial real estate.
My name is Dan Eisner. I have a company called Digital Reserve Technologies. We're a sponsor of a variety of tokenization projects, largely turning financial products into tokenized assets. Principal project that we're working on is something called OilCoin Digital Reserve. The purpose is ultimately to turn oil assets globally into a global currency.
Hi, my name is Jason Kirschenbaum. I'm the managing director of Elevated Returns. We're a hospitality asset management company based in New York. We own the St. Regis Aspen, and we just recently tokenized the St. Regis Aspen, and we completed our raise of $18 million.
And I'm Richard. I'm with Masterworks. We are an art investment platform. We essentially acquire, off our own balance sheet, multi-million-dollar pieces of artwork from Andy Warhol to Monet, Picasso, securitize and tokenize under Reg A+.
Very cool. Very cool. What is it like to let a lot of people own a Warhol and opening them up to that?
Yeah, I mean, it's been an interesting sort of ride over the last year in the sense that the level of interest comes from predominantly either the emotional side of things, which is sort of owning a share of a Warhol, so they might be art enthusiasts or just interested in the cultural side of it. And then, of course, there's the sort of investment aspect. So there's sort of the numbers behind the actual asset as an actual sort of investment. So it's been a balance of sort of pushing those two messages across, I suppose. But overall, we've had the platform running for just over a year. 4,500 investors have created accounts and participated so far. So yeah, it seems to be moving in the right direction.
Cool. Yeah. And Ari, could you talk a little bit about opening real estate up to a larger community in the secondary market of real estate, which has kind of been traditionally hard to access, and it's a cool thing that you're bringing that to a lot of people. How are you approaching, building your secondary market?
Right. So the notion of maybe some background, but the notion obviously of secondary offering is to take something, an asset that wasn't liquid, and give it liquidity. Traditionally, with real estate, commercial real estate, for example, you would have investment that will be 3 or maybe 10 years old, which is non-liquid. So investors, limited partners, they will sit on an asset for 10 years with no liquidity. Even if they need so, at any given time, they're stuck. So the notion of secondary markets, and that's kind of what all the secondary marketplaces are working on, and all the security exchanges, is really to create liquidity to non-liquid asset. In my humble opinion, it will take at least another year until we see significant volume. So it's not sufficient that you have the exchanges out there, but you actually need some volume. You need demand, you need supply, and these security exchanges will need to work really hard to bring that demand. And obviously supply, in my opinion, it's never a problem. So that's as far as concerned to secondary market. And what we are currently focusing on is really creating the product and bringing primary, setting that as primary offering. And that's what Jason is doing as well. So essentially you bring first the investors and you first bring in the LPs and you structure your offering in a way that it will be liquid in the future and open for trade.
How is the rest of the panel approaching bringing the money into your token and into your marketplace?
So with respect to OilCoin, the circumstance is very different. So in the case of the real estate investment platform and Art as well, single assets that are owned and then sold through a tokenization process. The idea of OilCoin is something somewhat different. When you look at many places in the globe, there is not real access to ownership of commodity. And when you think about oil is the largest, most liquid, really most important tangible asset in the global economy. When you think about monetary supply in other countries, people are burdened by volatility, by inflation, and that unstable currency creates a limit on economic development. And the idea ultimately is to create a global economic model that allows and takes advantage of blockchain technology to create alternative sources of money supply. The wealth that exists within oil controlled by sovereigns and oil-producing majors is quite significant. That asset value can be tapped, we believe, to turn into a form of money. And so as we think about accessing capital primarily outside of the United States, the dollar is certainly a stable instrument, not the sort of thing that people in the US are worried about. But outside of the United States, it's a very different problem. And so as the last panel was discussing, truly complex in terms of dealing with international securities laws, international monetary money transfer regulations, AML, KYC, and the like. And so in order to build a large-scale infrastructure such as this ultimately requires weaving our way through the myriad of problems that exist outside the United States.
I would add to that, we actually, raised for St. Regis Aspen $18 million, and it was not an easy process. Obviously, it was easy globally. We had a lot of investors come in from Southeast Asia through our network as well. But actually going out and talking to, institutional investors here, high net worth individuals, to convince them that to invest in, a single property, in a single asset. It's still very young. This product's still very young, but they want to believe you're in it for the long run. And that's the most important thing is, we're here and we're here to, build this community moving forward.
And I think we're slightly different in the sense that it looks likely that, from what I believe, that we'll be the first tokenized security under Reg A+. It looks likely that we'll be qualified in the coming sort of 7 days. So the reason for or benefit to Reg A+ is obviously we can have both accredited and non-accredited investors. So our current sort of focus has been predominantly on almost the retail side of things and really trying to push the fractional ownership of this asset class that was traditionally only accessible to those ultra high net worth individuals because the purchase price of our assets or artwork are between sort of 2 and 15 million. So that's sort of been our sort of predominant play. Of course, we also have discussions with the larger check investors, but our whole sort of premise and reason for existence is to sort of like democratize ownership of these assets. So hence the reason we went down the very expensive and very sort of drawn out process of Reg A+. And we do so for each individual asset. So every piece of artwork that we purchase is its own LLC, its own SPV, and it is ultimately qualified with the SEC. So we shall be doing this a lot.
Is there a level that the art is just not worth enough to do all that and create a whole company around every single piece of art?
I guess we'll see. Hopefully not. But so far, look, we've got a couple of assets under management and almost sold out of both these assets. It's been a long process from sort of education on the asset and how it works as an investment, but also that sort of securitization and fractional ownership. Then there's tokenization on top. So we've really tried to sort of tread lightly as we've progressed. Our business model doesn't necessarily live and die by blockchain. It doesn't live and die by tokenization. Those elements just support what we're trying to ultimately achieve. So the idea of fractional ownership, there was racehorses mentioned previously, there's antique cars. So there's a lot of creativity coming in the market. I think that once we have sort of these securities token exchanges that allow for trading, buying and selling of securities in tokenized form, it's going to change the game. But at this point in time, we're sort of offering a product that works without that, but we've built for the future.
Jason, unlike everyone else on the panel, your approach has been to take an individual asset versus building a platform first and taking this hotel and trying to tokenize it. And no one really knows which strategy is right, like whether you go with the asset first and tokenize an individual, or you build a platform to tokenize all of that type of asset. So could you speak a little to, like, why you chose that approach and why you think it's going to work better?
Yeah, of course, David. We believed that it was better first to prove the concept of actually tokenizing a real estate asset. We use the St. Regis as that. We want to go through, all the process. I think when people mostly, they start off and they say, okay, first we're going to build a real estate platform, and we're going to do the front end, and then we're going to raise, and next, like, what's next? Whereas here, we were just like, we have the property, we need to get, we need to get Marriott to approve it, we needed to have our lenders approve all this, which all takes time. So for us, it was just proving that we can get this off the ground and prove the concept, and now we're going ahead and creating a platform for elevated returns to tokenize more real estate.
And Ari, you kind of went the other way with platform first. So what assets within your platform are doing well, and what are the traits about them that are proving that they can create two sides of a marketplace?
Mm-hmm. Well, as a matter of fact, we actually took a very similar approach to Jason's approach, which is very smart, taking an asset and creating a POC, right? So you want to bring one asset or maybe a couple of assets that you can take a small LP position, that's a limited partner position. So we take a slice of the equity.
I see what you did there.
Right. So, well, no pun intended, but essentially that's what we do. We take that piece, we take, say, 5 to 10% of an equity in the equity stack, and it's not dependent on us, so it's something called best effort. The deal will be funded anyway. There is a bank underwriting the deals, and there are other investors that are actually investing in the deal. So we're just adding, say, 10% of the equity required. Now, what does it give to investors? It gives them access to institutional grade real estate in that case. Prime locations in Manhattan, like Chelsea or San Francisco or LA. So it's a very similar approach, and we're definitely bullish on rather than creating a platform, building a POC and running first projects, and maybe in a few months, hopefully, there will be secondary market that is active enough, and potentially that's the best way to go.
Cool. Daniel, you're in a spot where you're working with oil. It's been one of the most valuable assets for a very, very long time. It makes it much more stable, and you also are closer to a stable coin, but there's also like a risk because it's been around a while of becoming closer to a derivative. versus being an actual token. So could you speak a little bit about that challenge and like how you're positioned, against it?
Sure. So the basic idea is that it is in fact a stable coin, so a price stable coin, stable to essentially the front month of the curve in Brent, and so it's intended to be a tradable proxy for oil. Right now, the market is such that the only way to really trade oil would be for folks who are trading physical. These are large producers and distributors of oil. Or to trade on futures markets. And again, you need to be a very sophisticated investor to trade on futures markets. And then there are more limited products in the United States and Europe that are essentially ETFs. And the ETFs have some problems with them in that they're very tax inefficient and they're essentially managed as indexes of oil futures. And so the problem is that there is a decay in the value. And so the market for these assets is somewhat limited. By essentially democratizing the access, it creates a way for a global population to own oil. And the reason we think that's important is commodity value is essentially the best surrogate for global economic value. And so by tokenizing oil and making it available to the global population, we believe ultimately that it creates a much more stable store of value really than anything else that exists now, and something that very importantly is not subject to volatility for currency and inflation and monetary stability. And so what's really interesting to us about this situation is that before blockchain existed, there was really no way to access global capital markets and create a tradable instrument of any kind. And so with the development of blockchain technology, you now really for the first time in history have the ability to create something that's tradable on a global level. And in doing so, ultimately, we think what we're really after is changing the way people think about holding assets. And so the nature of the instrument is in fact a derivative, as you suggest, in that it's tracking the price in some way. But by being fully backed, it creates that reserve component, which we think is important in terms of maintaining that stable value.
Let's talk about because now you empower all these people to hold a token and hold a part of an asset they never could hold, but then what rights do they have? And how do you go about picking what rights they have in terms of when they can sell and when they cannot? Like setting up a governance behind these tokens is very difficult. So I was wondering if you could each just speak a little bit about how you approach the rights of the people that hold the tokens. You can just raise your hand. I don't know.
I mean, from our perspective, you're right. It is a challenge. And we're, of course, there's a number of solutions out there with smart contracts to ensure that a security is only traded within sort of like a pool of qualified investors. So, I mean, that's certainly what we're exploring at present. But I suppose first and foremost is we need to have the actual ability to sort of try and test this on an actual securities token exchange. But again, it is something that we see will just be coming through the smart contract itself.
When we've spent a fair amount of time working with government regulators in the U.S. and abroad, and one of the questions that was asked by some folks at the SEC is what happens on liquidation. And the basic idea, the reason liquidation is important is that to the extent there's a circumstance where the assets need to be, or asset value needs to be distributed to the token holders, what happens? And my response to them was look, there hasn't yet been a bankruptcy case in the United States involving tokens. And so anything that I say to you, and this is me speaking to the SEC, is just something that we're making up because we don't really know what happens. We know that in the structure we can create a path so that the asset value is ultimately to be distributed to the token holders, and that's of course what we've done. But it hasn't been tested in the courts and may not be for a long period of time. In terms of the basic notion of governance rights, shareholder rights relative to the assets that are underlying the tokens, our approach has ultimately been around creating stable value. Other projects can layer in governance and voting and things like that. Again, I'm a career lawyer and ran the private equity practice at major law firms before moving into the token space. And in my experience, the kinds of protections that are being offered to token holders is really economic only, and that the control of the systems are basically centralized rather than decentralized. So it's always struck me then that the importance of protecting the token holders needs to come through disclosure. And you mentioned A+, and I hope you get it done in 7 days. Good luck with that.
Sarcastic.
Hopeful.
And we've spent a fair amount of time thinking about actually filing an S1 and being registered as a public company and talk to the SEC about that. But to me, the most important thing that folks in our position where we're selling tokenized value to a broad base of holders is disclosure, and so that whatever the governance rights may or for the most part may not be, at least the holders have the ability to have that information.
Yeah, and I'd also just add that it's even in our public filing, but if there was any exchange of a token using blockchain, everything still needs to be tracked and recorded with our transfer agent. So there's always a record off-chain in the sort of, let's call it old school style, where track of ownership of shares will always be kept. And there's a common question asked by most to say, well, what if I lose my tokens? And the answer is, well, it doesn't really matter. We've still got record, and you still own those shares.
That's a really important point. As I think about the next wave of projects that move away from sort of true peer-to-peer cryptocurrencies, the projects really are being built with
where the human comes in.
Well, yeah, I mean with protection, and so that the tokens are being traded on permission systems rather than fully permissionless. That there is some sort of either transfer agent if it's required under law, or other mechanisms to verify who the holders are, doing KYC not just in the initial issuance, but ultimately in the secondary liquidity. And so one of the real problems in crypto up until this point is hacking and the ability to lose real value. I do believe that with the custody solutions that some of the institutional players are developing, that whole issue gets squeezed out of the system.
Yeah, maybe to add, a simple approach would be that you're just selling equity. So with securities like real estate, for example, you're issuing regular equity, and nothing says that you cannot keep your shareholders on a ledger, a digital ledger, versus a spreadsheet or a piece of paper. So that's just a matter of how you keep the ledger. But essentially, you just issue regular equity.
And that's sort of how we position it with the SEC as well. Like, we're just sort of putting it on a ledger, but doesn't seem to fly.
Well, look, the problem that the SEC has raised in some of their responses for different kinds of Reg A filings is that you have this fundamental problem, which is what happens when your ledger doesn't match the blockchain, and nobody's been able to give the SEC a good answer to that question.
Yeah, cross that bridge when we come to it. Doesn't seem to work either.
Yeah.
Right. As long as you can control the transfer of ownership, then you're good.
In going through, you guys have rare experience in taking, art, real estate, oil, and tokenizing it. What's been the most surprising hurdle to deal with the SEC?
Well, I'm probably the only person in here who's kind of met with Valerie Shpanya, who's the czar, with Jay Clayton, who's the head of the SEC, and talking about the situation. One of my partners is a former CFTC commissioner. We spent a lot of time talking to the CFTC. And look, the real problem is that they don't really know the answers either. That they've got a lot of information coming to them. They're regulating through enforcement right now, which is what it is. They've made it very clear that in order to do anything, you need to comply with the laws as written. And I don't think that the laws themselves don't work. I think that people's expectations of what the laws should be don't match with what the laws are. And so, when people first started to look at blockchain technology, and all of a sudden you have this ability to transfer asset peer-to-peer on a global basis, everyone wants to know, well, why doesn't the law just let me do it? And the reason ultimately is that it's important to control money flows, and it's important to provide protections to investors. And whether you believe that investors should protect themselves or the government has some role in it or not, the SEC is mandated by legislation to protect investors' interests today. And that's true not just in the US, but outside the United States as well. The regulators have a real interest in monitoring money flows and monitoring the conduct of market participants. And so the way this is going to get resolved is to be fully compliant. There may be certain sorts of accommodations that are made either on a case-by-case or categoric basis. But for the folks who understand the regulations as they exist now, the only answer is to comply fully.
I would add to that because we actually went through the SEC when we did our single asset REIT for St. Regis Aspen before we tokenized. They asked certain questions like anything else, and that was one of the things we saw what they wanted, what they didn't want, what they had questions with. So essentially we took our filing, which was a Reg A, and we turned it into a Reg D 506C placement memorandum, and I think we're comfortable with that, and we know that the SEC comes back and they ask us questions, we're there, and we're always happy to answer whatever they have.
Cool. Maybe as a last question, thinking about more of like the technical challenge in building your platform, because this is, there's so much innovation going on. People can't even hire enough blockchain developers fast enough. So maybe, as you've been through this and other people haven't, what is a surprising technical challenge that you ran into and you thought it was a 2-week thing and it turned into a 6-month build, and that's kind of something that I would be very interested in hearing.
Smart contract auditing, that's what I'd say. We went through EY and KPMG as our smart contract auditors, and it should have been, I should say, hopefully it should be a month process, but it dragged on to be over a 2-month process.
We've built our system on a couple of different platforms already, just to see what we think works best. And the challenge has been that depending on the system that we're working on, that system provides resources in different sort of ways. We've decided, at least in the initial stage, not to build our own blockchain, which would be a very time-consuming kind of first step for us. So as we've looked at the different sorts of platforms, we've had different levels of help and assistance from the core development team. Things which are open source are sometimes hard because you've got to actually go into the open source network to get people to develop the tokens in the way that you want, and there are some unique aspects to what we've done that we've built into our token. Ultimately, I think the process will get easier, and I think the simple process of creating tokenization itself is going to be something that is accessible to many.
Yeah, and honestly, I don't really feel that it's been so much a challenge on the actual development side of things, but we've sort of been running a development and qualification in parallel, and obviously with every red line filing that comes back, it just influences the actual technology. So we've spent sort of 8 months as well developing our own exchange to essentially sort of like create conceptually the stock market for fine art. But as I mentioned, as we've been going along with the SEC, there's so many different requirements to integrate with transfer agents and other third parties that's probably been our biggest challenge, and the majority of where the time spent is just iteration after iteration.
Cool. There you have it. Go tokenize your alternative asset. You know everything you need to know. It's that easy. These guys did it.